Happy New Year. I wish you all the best for 2023. I can't believe how fast time flies, and it is time for our first quarterly statement House View Solutions update for the year already. As always, I will be doing a quick economic and market update and also an overview of the MFP focused model portfolios and the momentum focused fund of funds for the quarter ending December 2022. 2022 was characterized by uncertainty and volatility as investors globally grappled with a range of challenges, including rising inflation and interest rates. The interplay between inflation, interest rates, and economic growth is likely to continue and once again be a main driver of global asset class returns in 2023. In the absence of further energy or supply chain shocks, it currently seems likely that global inflation should fall in 2023, led by the United States. There's a lot of uncertainty and many questions about what financial markets, both local and global, have in store for 2023. The four important questions that stand out are: firstly, have we entered a new regime of greater macro and market volatility? Globally, we are facing higher levels of geo-economic fragmentation, reduced liquidity, lower growth patterns in China, increased global conflict, and higher inequality. This could lead to shorter and more erratic economic cycles, resulting in more volatile discount rates and lower equity valuations. Secondly, what are the risks of over-tightening in monetary policy? Although an over-tightening in monetary policy raises the risk of negative growth outcomes sooner, the risk of under-tightening poses a bigger threat. Unhinged inflation expectations could force central banks to tighten policy even more over a longer period, damaging economic growth and jobs. Thirdly, where will interest rates plateau and when will financial markets see the big pivot to easier policy? In our view, central banks need to have a clear sight of a sustained deceleration in underlying inflation and a reversal in tight labour market conditions for interest rate cuts to be considered. Market-implied policy rates point to a peak in the US federal funds rate of 5% in the first half of the year. Market participants are pricing a cut before the end of 2023 after an expected pause. And lastly, when will interest rates peak in South Africa and when will the Reserve Bank cut again? The SARB is likely to hike rates further in the first quarter of 2023 to arrest the spread of broad-based inflation pressures. However, the likelihood of an improved global risk backdrop towards the end of 2023 could see the SARB reversing policy. The risk is nevertheless biased towards a tighter stance if higher political uncertainty drives the rand weaker for a sustained period, leading to an uncomfortable jump in inflation expectations. Now, while a slowdown in global economic activity in 2023 seems almost inevitable in reaction to previous policy tightening cycles and the erosion of real spending power, the extent of the growth slowdown remains uncertain. A mild slowdown, or so-called soft landing, is certainly still possible, but more indicators, particularly inverted yield curves, which means that the short-term interest rates are higher than long-term rates, are pointing to the increased probability of a global recession in 2023, as illustrated by the following slide. In the US, the recent inversion of the 3-month and 10-year part of the yield curve speaks to what has historically been a reliable predictor of a US recession within the subsequent 12 months. While global equity markets could be under pressure during a large part of 2023 as they deal with the potential for recessions and the final phases of rates tightening, there could be some relief for equities towards the latter part of the year, as markets start looking beyond the downwards growth cycle and begin discounting an eventual Fed move to lower interest rates. So, it looks like there will be some more pain during the first half of 2023 before we will start seeing some gains. With that being said, the old saying that the economy is not the market still holds true. As an example, the JSE All-Share Index was up by 8.6% since the beginning of the year, at an all-time high of just under 80,000 points, as at the close of business on Friday, the 13th of January. Even though cyclical slowdowns or recessions have not been good for growth assets like equities historically, the following chart does paint a very interesting picture. This illustrates how US GDP growth and the S&P 500 returns stack up from 1980 to the second quarter of 2021, net of inflation. The data points left of the vertical red line indicates periods of negative GDP growth. In summary, over the 41-year period, there were 6 periods of GDP decline. In 5 of the 6 years with negative GDP growth, including 2020, there were positive stock market returns. The only time that the market and GDP numbers were both negative was during the financial crisis, global financial crisis of 2008. This once again illustrates the importance of staying invested for the long term if one's circumstances and time horizon allows for it. The worst mistake an investor can make is to sell everything at levels that present sound long-term investment opportunities due to short-term fears. The unpredictability and volatility of short-term returns are also illustrated by our asset class summary over different time periods as at 31 December. Even though equity markets took a breather in December, returns during October and November were very encouraging. Here we have a quick overview of the returns of all asset classes as at 31 December. As a further indication of how tough the year was, local cash proved to be one of the best performing asset classes, ending the year up 5.2%. Interestingly, it is the local asset classes that contributed positive returns during 2022, with the rand strengthening during the last 2 months of the year and ending approximately 6% weaker to the dollar than where it started. A lot of the cushioning of negative global asset class returns were negated. It's also worth mentioning that the 2 best performing asset classes over 5, 10 and 15 years, global equity and global property, were the worst performing asset classes for 2022 and also for December. In rand terms, this once again illustrates the importance of a well-diversified portfolio and that diversification is still the only free lunch in investing. Our house view multi-asset solutions, the MFP focused model portfolios and the momentum focused fund of funds, being market-linked funds, are of course not immune to the volatility in equity markets, both foreign and domestic. They are well-diversified solutions with the appropriate exposure to different asset classes relevant to the time horizon of the fund, which include exposure to bonds, cash and property, both domestic and global. As a result, they are directly affected by and participate in the returns from these asset classes. Returns for the quarter ending 31 December were very encouraging and once again shows the importance of staying invested during times of increased market volatility. MFP focus 3, 5, 7 and 7 unconstrained were up by 5.242, 7.59, 8.66 and 8.3% for the quarter, and the momentum focused fund of funds delivered positive returns of 5.02, 6.45 and 7.94% for focus 3, 5 and 7 respectively. Please remember that returns longer than 12 months for the MFP focused model portfolios are simulated returns. Thank you.